Hey folks, welcome to 2025. We're having a conversation on the fiscal outlook for the year 2024. At the very least, was a tempestuous period. We had finance bill being thrown out. We had a supplementary budget. We had a combined 7th and 8th review of the IMF program. We want to see what the outlook looks like for 2025, and you're privileged to have, as always, Churchill Ogutu, economist, IC Group. Karibu sana.
Asante sana.
Churchill, let's start from here. One of the things we saw at the tail end of the last year was the president signing into law the amended Division of Revenue Act. And what that did was to enhance the equitable share. Initially, the conversation was around at 380 billion. We're now at a compromise of 387.425 billion. Speak to us around the implications of this, especially around the fiscal deficit conversation.
Yeah, thanks. So we are looking at a baseline as we start this year of a deficit of around 770 billion. So as you correctly pointed out, initially, this is even before the finance bill was shelved off. We are looking at an county allocation of around 400 billion. And because of the effect of the shelving off of the finance bill 2024, that one was reduced to 380 billion. And obviously there was that push back between the Senate and also Commission of Revenue Allocation and also the National Assembly, and hence that compromise of an additional 7 billion, 7.425 billion increase. So obviously that increases the deficit slightly from the baseline that you're looking at. But remember, these numbers tends to be moving targets. We've seen even in terms of from a point of the target vis-a-vis the outturn, and also the revision in the targets even over the course of the financial year, any given financial year. We're also obviously expecting supplementary budgets to be tabled sometime this month. It could be now that Parliament is on recess. So probably they will find a way of doing it so as to be in line with the IMF's conditions, but nonetheless, those are the things that tends to revise the deficits upward or downward in any given fiscal year.
But even before we jump into supplementary budget 2, Churchill, looking at the revenue outturn thus far for the financial year, we saw a very lethargic start, understandably because the revenue raising measures were not there, courtesy of Finance Bill 24. But then we have had the conversation around the tax laws amendments. What are your expectations going forward in terms of the revenue outturn?
Yeah, obviously, looking at even the first 4 months of the current financial year, the revenue was quite, as I say, lethargic in terms of the outturn vis-a-vis the target. And if you look at on a prorated basis, we actually lower by 128 billion Kenya shillings vis-a-vis 78 billion a similar period a year ago. So that just speaks to the kind of fragile macroeconomic environment that we are in. And obviously, it's coming at a point whereby last month we saw that the tax revenue bills being assented into law, the tax amendment, the Tax Procedures Act, and business laws, which obviously has some revenue impulse on them. I think the number was around 180 billion over the course of this financial year. So obviously you can see that there's an emphasis by the National Treasury to be able to make ground of what was lost earlier on in the fiscal year, and that might give us a sense that probably they are eyeing at least increasing their revenues over this financial year. And even as we look at the supplementary, I mean, there are some offsets. So they are getting from the revenue, and which will be spent from some of the additional measures. But by all intent and purposes, we are looking at slightly higher revenues by all these measures, at least to be able to play catch up with the targets that they initially had before the shelving off of the Finance Bill 2024.
But Churchill, I respectfully think that 175 billion is too much of a stretch. I don't know what you make of that projection, courtesy of the additional revenue out of the amendment bills we saw.
Absolutely. Look at Finance Bill 2023. The target was 215 billion. The outturn was around 75%, if you may correct me, around that year. So we never get the full 100% target around that they are envisaging in any tax revenue bills. And also that speaks to the issue around the costing, because it's one thing we all know the blanket figure, 175 billion. And this is the number that was there before the amendments that were made during the third reading stage.
Yeah.
So we may need now to step back and see what is the impact. And that can be assessed if there are various costings to the individual clauses, what is the tax implications, and after the amendments, what is the revised allocation. So right now, even we're looking at a baseline, the 175 billion. We may not even get that because of the amendments and also because of the macroeconomic environment that we are in. So those are some of the balancing acts that typically are attendant with the implementation of the tax revenue measures.
Churchill, for every market watcher looking at Kenya, one of the big unknowns for 2025 is the IMF program comes to a sunset date. What are your expectations going forward? There's been talks. I've spoken to the IMF mission chief. She has indicated we're already in talks with the government about a potential succession program. I spoke to the chairman of the President's Council of Economic Advisors, Dr. David D, and he told me, as far as we're concerned, the country is out of recession, receivership, he calls it. We don't need a succession program. What do you think?
If you look at even the optics around the IMF program, it's more than the usual financing that you're given. I mean, the program that is coming to an end, you're looking at slightly over $4 billion that is to be disbursed over the whole 4-year program. And it's not just the financing aspect. There's also the comfort even to the international investors. So that means that there's some anchor that the country gets when it gets into the international market. By all intents and purposes, they have not mentioned any form of going back to the international markets, at least this in the near term, in as much as the financial conditions are easing on a global scale. But they need, that now leads that even in as much as the program is coming to an end, there's that comfort that the investors, international investors, might want to see, at least to be able to give them comfort that the reforms that were in the current program might be sustained. So looking at even some of the forms of successor programs, we've discussed this before, I don't think there's a scope of a financing program. Probably now that leaves us to either a precautionary lending instrument, what we had prior 2000 and before 2018, the standby arrangement, or even a non-financing program entirely, things such as policy coordination instrument. So I think the balance is now tipped towards a non-financing instrument, at least to be able to give comfort that this kind of reforms will be able to be implemented. Remember that there are some structural benchmarks that are still that we expect to be implemented.
Even with the precautionary program.
Exactly.
Absolutely.
And even in the context of the current program, looking at implementation of the medium-term revenue strategy. Obviously, next month, we expect that some of these, there could be some form of reforms in the personal income tax, corporate income tax. I mean, this was supposed to have been done last year in the context of Finance Bill 2024. There is hope that in the context of the structural benchmarks, we could see next month this kind of revisions. There's also the aspects around the supplementary budget, at least to be able to sort of preserve the fiscal deficit that was there, 4.3% after supplementary one. And even going forward, in as much as they are not within the fiscal targets, but there's that outlier programs. These are the targets that needs to be done. So those are some of the things that an IMF program, a successor IMF program, which I'm thinking will be within a non-finance instrument, will now be able to give comfort to international investors looking at Kenya to be able to assess that the reforms are still on track.
Churchill, I know you've given the caveat that you don't anticipate, well, there has been no signal that we intend to return to market. And of course, IMF programs give you a safety net. But don't you think that could be easily changed given what you've seen with Nigeria returning to market? Never mind the pricing was not as sweet as we would have expected. And also the fact that the conversation we were having around a $1.5 billion financing from the UAE has kind of gone muted. I've been seeking updates from the Treasury and no one seems to be giving any progress update.
That's the thing that on the baseline, at least as we start the year, we have not seen indications that they will go to the market, but there might be an opportunity for them to go to the market. You've seen even from a global scale, the rates are coming down, so that gives them some comfort to be able to go to the market, at least to be able to tap the international markets. Probably they may not do the way Nigeria did. Remember the case for Nigeria last year, late last year, they had a supplementary budget like a month to the end of their fiscal year. There were some revisions in the borrowing and they went to the market. So there was some form of desperation, which if the authorities are to be able to, if they would want to go to the market, they might want to avoid that so as to be able to avoid the steep yields that Nigeria got late last year. So it's a bit of a balancing act, probably just weighing the options. And I can say that the authorities, they have some luxury of time. 6 months by the end of this financial year. Look at where domestic borrowing
aren't we ahead of target there, by the way?
Exactly.
Yeah.
At least that gives them some comfort. And remember, this is something that we've been having even when initially we saw the annual borrowing plan, the plans of doing the debt switch, the switch auctions in the domestic market. That didn't come to fruition, at least as far as we are at this point in time.
November plan,
So that means that from the domestic side, they are ahead of target, and that now gives them some comfort that come April and May this year, they can now be able to refinance these outsized maturities without having some refinancing risks that was there by the time they were coming up with the annual borrowing plan. So it's basically weighing the conditions, but at least there's some luxury of time. On the Eurobond side, we have the $900 million maturing in 2027, but it's maturing in piecemeal. So this year we're anticipating $300 million maturity around May thereabout. So that has been staggered rather than the bullet maturity that we're expecting in the 2028 Eurobond, the $1 billion.
Churchill, on that point of the anticipated switch auctions, which in November at least we know it was shelved, I still expect that the planned switch auction for early 2025 needs to materialize, given the very reason you've raised around the lumpy maturities we shall be facing at that point. Do you hold the same view, or do you feel that given the way we have been seeing rates trending, the government will be persuaded that we really don't have pressure here?
Yes, it now, the longer conversation, the broader conversation around that is now basically the credibility of the fiscal authorities, that they are telling us this thing, they will implement this thing, and then they pivot elsewhere. So that's the broader conversation, and that's something that probably may give some discomfort to other aspects of the market. And if you look at cross regionally, other markets, they have a laid out bond auction calendar. And this is something that we've been talking about. So the annual borrowing plan this time round with that sort of a calendar was telling us that this is what they anticipate to do. But now the authority is not sticking to plan. It's bringing some credibility issues. So whether they do it initially, the April maturities, the 100 billion shillings, they wanted to at least switch it in November last year. The 104 billion, they had anticipated to do it sometime this month.
Correct.
Whether they do it or not, I think it brings this whole credibility issue to the fore. And as I mentioned earlier on, they have some luxury on time because the math was, unlike other fiscal years, remember the last 2 financial years, by the time you were around April, the domestic borrowing outturn as compared to the target was less than 60%. And if you are faced with outsized maturities that we are seeing this year in April and May, it creates even some confidence dent around the refinancing. But at least this point in time, the argument that can be made is that they're already ahead of the curve, so they can now be able to sort of refinance those outsized maturities in April and May without considerations that they're still behind the curve. So I think that is what they're leaning on.
Speaking about being ahead of the curve in terms of domestic borrowing, to the relief of the exchequer, yields have fallen precipitously from the highs we saw them sometime last year. And my question here is, do we anticipate that Treasury will now come back to us and tell us we are rejigging the borrowing plan for FY 24-25 to lean a lot more on the domestic side than we had thought earlier.
Yeah, that is a probability. And if you look at, yes, if you look at the global macro environment, yes, you can say that there's a case of the rates are also equally coming down, but not as fast as what you've seen at the short end of the yield curve at the domestic side. So with all that is happening, we're expecting Trump's swearing in around 2 weeks from now. So, and the market is that there's some inflationary bias with all the protectionist agenda that his administration will be able to bring on. So there could be a slowdown in the global rates cooling down.
Yeah, yeah.
At least for the Kenyan market, we've seen and by all intents, the outlook, inflation has come down over the course of last year, that disinflation trend. Currency stabilized over the course of last year. And there's all indications that it could steady at these levels, looking at what's happening in the FX interbank market. And that just points out to favorable inflation outlook even into 2024, at least 2025 rather, from the standpoint that we are in right now. And that speaks to at least further easing. So they could be a case that they could now go to the domestic market. But now, will they keep on leaning on treasury bills, because that is where we've seen the sharpest moves.
Yeah.
As of end of last year, we're looking at close to 5 percentage point decline on average across the three tenors in the treasury bills. Not so in the other segments of the yield curve. So it's still coming down, but at a more at a slower pace than what we are seeing in the treasury bills. Treasury bills are pretty much cash management instruments rather than for domestic borrowing. So that is also the balance that the Treasury will contend with. Obviously, it has some positive bias that will be refinancing this outsized Treasury bills 6 months, 12 months down the line, but at a much lower interest rates cost as compared to where we are. So, but it's still a balance, but the bias probably you can argue that they might lean towards domestic borrowing in general.
Churchill, on foreign exchange, it seems like 129, 130 became the resistance level we have seen around the USD case. But many have asked, given the sort of trends we are seeing on interest rates, on inflation, don't you think there's more headroom for appreciation of the case?
I think there was, but also from the authorities' action, at least late last year, you could argue that they didn't want further appreciation from the levels that we are in. And you saw anecdotal evidence. I mean, we really don't have proof as this part of the market in terms of the interventions that come, but the anecdotal evidence points out towards the central bank coming to purchase dollars from the market. And if you sort of look at how the net foreign assets in the banks, this is the commercial banks excluding the Central Bank of Kenya, you could see between the months of July last year to September last year, there's a decline of around $681 million in the net foreign assets in the banks, which sorts of led credence to the fact that the CBK was coming to purchase dollars from the market and sort of holding further appreciation of the shilling from the levels that we saw. FX interbank market activity from around June last year all the way to the end of last year, the volumes sort of nosedived to $200 million on average, compared to $1 billion that you saw in the months of February and March. And those months in the first quarter of last year, that's where we saw the sharp appreciation of the shilling from 160 to 130 levels. So from going forward, and if you sort of extrapolate what transpired towards the tail end of last year, we could see that even getting into the current calendar year, there could be that stability of the shilling against the dollar. Obviously, as interest rates are coming low, inflation outlook becoming more favorable. It's interesting play of things that we could expect some stability amidst what's playing out even in the real sector and the inflation.
And as we anticipate indications around supplementary budget 2, one of the big questions is how do we handle pending bills, because one of the characteristics of FY 24-25 so far has been the absence of that conversation because of the verification committee. But the numbers are quite outsized when you look at what the Auditor General is putting out. How do you see that being penciled into this consideration?
I think, and what we've seen even across other markets is that pending bills are sort of staggered. You don't pay out this full over 600 billion in pending bills in one fiscal year, but you sort of come up with a plan of staggering the payments, at least to be able to ensure that you're balancing the current spending requirements and also this historical domestic arrears, the pending bills, so to speak. So that needs to be out. There needs to be a plan of settling these long outsized pending bills that are long overdue. And also what we have seen in the previous cycles of the fiscal year is that there is an emphasis from the National Treasury to the ministries, department, and agencies, to a small extent to the counties, to prioritize payment of pending bills as a first charge. But we haven't
never
seen
happens.
exactly. We haven't, yeah, so it's pretty much lip service, or we haven't seen there's a huge implementation risk to address the pending bills. So potentially, as we see the verification report coming out, I expect that there could be like a staggered plan of retiring these pending bills, and we need to see a matrix around that, rather than what you have seen, the lip service that has been said, that has been put forward so far.
Churchill, I'm really skeptical that once Supplementary Budget 2 comes, we'll be able to play still within the 4.3% target of fiscal deficit in FY 24-25. And the reason is what you're talking about in terms of pending bills. And the second one is, if you look at Supplementary Budget 1, there were so many unfunded requests, and especially from education and healthcare, crucial core sectors. My expectation will be playing around 4.8, 4.9. I don't know what your expectation is.
Pretty much those levels. And the math here is, we saw the impetus from the tax revenue bills that came out that were sent into law late last year, 175 billion. So that's a plus. On the negative side, we have the 7 billion increase to the counties. We also have these unfunded requests, the carryovers from FY 23-24, which have to be done, which are materializing in the current financial year. And also within the supplementary budget, from my reading of the IMF report, is that now the authorities, the ministries, department, and agencies need to further look at areas that they can scale back their budgets. Unfortunately, we all know that development spending
will be the casualty,
evidently. But now there's that balancing act. But by all purposes, by all the levels that we've seen in the IMF report, is that they will want to see the fiscal deficit around the 4.3% as at the end of supplementary 1. So 4.9%, I mean, we could end up there, which pretty much is within comfort levels. Remember, the last financial year, we were targeting around 5%. We ended up at 5.7%.
Yes.
So that pretty much looks to be the trend, that there's a target, but you sort of add close to 0.6% higher than what has been penciled in.
Okay. Final question, Churchill. What's your parting shot in terms of your fiscal outlook for 25?
I think from a macroeconomic backdrop coming into 2025, it's looking more favorable as compared to where we were 2023 getting into 2024. We've seen inflation easing a bit. We've seen currency stabilizing. We've seen even the private sector sentiment starting to improve following the events of mid last year. So getting into 2025, there's that favorable environment that could give some stability. I think also the authorities need to do a few things to ensure that the reforms that they started late last year should also filter into the current financial year, at least to be able to ensure that that momentum is sustained. Obviously, within the IMF program, all eyes are on the successor program, and also just to build on the reforms that are there. Debt sustainability still on our minds, the path to the 55% in present value terms by fiscal year 2028 or 2029 thereabouts. So how will the authorities take us amidst all this competing newer financing obligations, the UAE loans? There's talks about pivoting to other non-dollar denominated euro bonds, the samurai bonds, the panda bonds. There are talks around the debt swaps and diaspora bond that we saw coming up last year. So all that has to be implemented in a way that we are still sustainable even going forward. And that is how that's what we are looking at, how the authorities implement these things. And obviously on the public finance, we are getting into the public finance, the budget cycle. Already we started it, but now we are getting into the tail end of it, this first 2 months of the current financial year, and the emphasis will be on public participation. We saw even last year, even on the expenditure side, those and also the tax laws that were implemented last year, there was that emphasis on public participation. So even getting into the context of Finance Bill 2025, I do expect that even as early as next month, when we start to see the reforms around tweaking the corporate income tax, the personal income tax, there could be that public participation way early before we actually see the Finance Bill 2025. So those are my broad thoughts around the fiscal outlook.
All right. We've been having a conversation with Chachi Nogutu, economist at IC Group, on outlook for the fiscal environment for 2025, including what many think is the elephant in the room this year, and that is the lapsing of the IMF program and the defining of the path ahead beyond having the current IMF program. We wait to see how that pans out. We shall keep you posted as and when issues develop. Stay tuned.